Most people think they understand how taxes work until they actually look at their paycheck and realize the numbers don't add up the way they expected. You see your salary, do some quick mental math, and somehow what lands in your bank account is way less than you calculated. And the confusing part is that nobody really explains how this system actually functions. They just tell you to file your taxes, hope for the best, and pray you don't get audited. Here's what actually happens with your money, and why understanding this could save you thousands of dollars every single year. The first thing you need to know is that the United States doesn't tax all your income at one flat rate. A lot of people think if you're in the 24% tax bracket, you're paying 24% on everything you earn. That's completely wrong. And this misunderstanding costs people serious money because they make financial decisions based on information that isn't accurate. The system works through what's called progressive taxation. Your income gets divided into chunks, and each chunk is taxed at a different rate. Think of it like filling up containers of different sizes where each container has its own price per gallon. The first container is cheap, the second costs a bit more, the third even more, and so on. For 2026, there are 7 tax brackets: 10, 12, 22, 24, 32, 35, and 37%. But here's the part that changes everything. Only the income that falls within each bracket gets taxed at that rate. Your entire income doesn't get hit with your highest rate. Let's say you're single and you make $60,000 a year. You're not paying one flat percentage on that whole amount. The first chunk of your income up to a certain point gets taxed at 10%. Then the next chunk gets taxed at 12%. Then 22% on the portion that falls into that range. Each slice of your income climbs through these brackets like steps on a ladder. This is why your marginal tax rate and your effective tax rate are two completely different numbers. Your marginal rate is the highest percentage you pay on your last dollar earned. Your effective rate is the average of all the taxes you paid across all those brackets. And your effective rate is always going to be lower than your marginal rate because of how the system stacks. Most people freak out when they get a raise because they think they'll jump into a higher bracket and somehow take home less money. That's mathematically impossible with how progressive taxation works. Yes, the additional income might get taxed at a higher rate, but your previous income still gets taxed at the same lower rates it always did. You'll always take home more money if you earn more money. But here's where it gets interesting, and this is something most people completely miss. Your taxable income isn't the same as the money you actually earned. Not even close. Before the government starts applying those tax brackets, they let you subtract a chunk of your income completely tax-free. This is called the standard deduction, and for 2026, it's $16,100 if you're single. If you're married filing jointly, it jumps to $32,200. That's a massive amount of income that never gets taxed at all. So if you're single making $60,000, you subtract that $16,100 standard deduction, and suddenly your taxable income is only $43,900. The government only applies those progressive tax brackets to the $43,900, not the full $60,000. Right there, you've eliminated taxes on over $16,000 of your earnings just by existing and filing correctly. Now, you might be thinking you can do better than the standard deduction by itemizing your deductions instead. Maybe you've got mortgage interest, charitable donations, medical expenses, things like that. You can choose to add up all those individual deductions instead of taking the standard one. But here's the catch. You only want to itemize if your itemized deductions add up to more than the standard deduction. Otherwise, you're just making more work for yourself at tax time for no benefit. For most people, the standard deduction is the way to go because it's higher than what they'd get from itemizing. But if you're someone with significant mortgage interest or you donated a lot to charity, running the numbers on itemization might save you money. And there's another layer most people don't think about. Seniors over 65 get an additional standard deduction on top of the regular amount. Single filers over 65 can add another $2,050. And married couples can each add $1,650. Plus, there's a new provision allowing seniors to claim an additional $6,000 deduction, though it phases out at higher income levels. The point is, understanding what your actual taxable income is versus what you earned matters enormously because that's what determines which brackets your money falls into. But we're not done yet because what shows up on your paycheck isn't just federal income tax. There's a whole other set of taxes being pulled out that work completely differently, and most people have no idea how much they're actually paying into these systems or what they're even funding. That's where things get really interesting because the money disappearing from your paycheck isn't just going to income taxes. Those FICA taxes, that's what they're called. Social Security and Medicare. Every paycheck, you're seeing deductions for both, and they work completely differently than income tax. For starters, these aren't progressive. They're flat rates applied to your earnings, and your employer pays half while you pay half. The Social Security portion is 6.2% of your wages, and your employer kicks in another 6.2%, making it 12.4% total going into the system. Medicare is 1.45% from you and 1.45% from your employer, so 2.9% total. Add your portion together, and you're looking at 7.65% coming out of every paycheck before you even get to federal income tax. But here's what makes Social Security tax different from everything else. It caps out. In 2026, you only pay that 6.2% on the first $184,500 you earn. Anything above that, no Social Security tax. So if you're making $200,000, you pay Social Security tax on the first $184,500 and zero on the remaining $15,500. Medicare tax doesn't have this cap though. You pay that 1.45% on every dollar you earn, no matter how much you make. Actually, there's more to it. If you're single and earning over $200,000, married filing jointly over $250,000, or married filing separately over $125,000, you get hit with an additional 0.9% Medicare surtax on top of the standard rate. That extra surtax only applies to earnings above those thresholds, but it means high earners are paying 2.35% total for Medicare tax on their top dollars instead of the standard 1.45%. Now, if you're self-employed, this gets brutal. You're paying both the employee and employer portions because you are both. That means 12.4% for Social Security and 2.9% for Medicare, totaling 15.3% right off the top before any income tax calculations even begin. The government does throw you a bone though. You can deduct the employer equivalent portion when calculating your adjusted gross income, which softens the blow somewhat, but you're still writing much larger checks than someone working a traditional job at the same income level. What's wild is how much money flows through this system without people really understanding where it goes or how it works. You're funding Social Security benefits for current retirees and Medicare coverage for people over 65, and theoretically, you'll get those benefits when you retire. But the math on whether you'll actually get back what you put in, that's a whole different conversation, and not one the government wants you thinking about too hard when you're watching chunks of your paycheck disappear every 2 weeks. Let's bring this back to something concrete. Say you're single making $75,000 in 2026. First, you subtract the standard deduction of $16,100, leaving taxable income of $58,900. The first $11,925 gets taxed at 10%, costing you $1,193. The next $36,700 gets taxed at 12%, adding $4,404. The remaining $10,275 gets taxed at 22%, which is $2,261. Add those up and your federal income tax is $7,858. But you're not done. You've also paid 7.65% in FICA taxes on that full $75,000, which comes to $5,738. So between federal income tax and FICA, you've paid $13,596 in federal taxes alone. That's over 18% of your gross income gone before you even consider state taxes, sales taxes, property taxes if you own a home, or any other government fees. This is why people making decent money still feel broke. They see $75,000 as their salary, but after federal taxes alone, they're down to $61,404 in take-home pay. Start factoring in state income taxes, which most states have, and you're losing even more. California residents at that income level would lose another chunk to state taxes. Even states with lower rates are still taking their cut. By the time money actually hits your bank account, that $75,000 salary might be closer to $55,000 in real spending power. Understanding the difference between what you earn and what you actually get to keep changes how you think about everything. That raise from $75,000 to $80,000 sounds like $5,000 more per year, but after federal income tax and FICA taxes, you're only seeing about $3,600 of that in your actual paycheck. Not nothing, but definitely not $5,000. This is why people sometimes feel like raises don't matter as much as they should. The government takes a bigger bite as you earn more. And while you're always better off earning more, the incremental benefit shrinks as you climb the ladder. You might be wondering if there's any way to reduce this burden, and the answer is complicated. Your FICA taxes are pretty much locked in. You can't deduct your way out of those. But your federal income tax, that's where strategy comes in. Tax credits directly reduce what you owe dollar for dollar, which makes them incredibly valuable. The child tax credit gives you $2,200 per qualifying kid. The earned income tax credit can be worth over $8,000 if you have 3 or more children and meet the income requirements. These aren't deductions that lower your taxable income. They're straight reductions in your tax bill, which makes them far more powerful than deductions for most people. There's also a new overtime deduction allowing workers to deduct up to $12,500 in overtime pay, or $25,000 if married filing jointly. This provision only lasts through 2028, but if you're working significant overtime, that's a meaningful reduction in your taxable income beyond the standard deduction. It phases out at higher income levels though, disappearing entirely once you hit certain thresholds. The tax code is full of these targeted provisions designed to incentivize specific behaviors or provide relief to particular groups. Deductions work differently. They lower your taxable income before you calculate what you owe. If you're in the 22% bracket and you have a $1,000 deduction, you save $220 in taxes. That same deduction saves someone in the 37% bracket $370. This is why high earners benefit more from itemized deductions than people in lower brackets. The math just works out that way. For most people, though, itemizing doesn't make sense anymore. The standard deduction is high enough that unless you have massive mortgage interest, huge charitable contributions, or significant medical expenses, you're better off just taking the standard deduction and calling it a day. Only about 10% of taxpayers itemize now, compared to around 30% before the tax law changes in 2017. The government essentially simplified things by making the standard deduction so large that itemizing became irrelevant for average earners. But there's a catch for high earners. Starting in 2026, there's a new limitation on itemized deductions for people in the top tax bracket. If your income puts you in the 37% bracket, the value of your itemized deductions gets reduced. This isn't the old P's limitation that used to exist. It's a new calculation that effectively makes your deductions worth less once you hit that top bracket. So even if you have enough deductions to make itemizing worthwhile, you won't get the full benefit if you're earning serious money. The SALT deduction cap increased to $40,000 for 2026, which helps people in high tax states like California or New York. Before this change, you could only deduct $10,000 in state and local taxes, which was painful for people paying 6 figures in state income tax and property tax. Now you can deduct up to $40,000, which provides real relief if you're in that situation. But again, this only matters if you're itemizing, and it only helps people who are hitting that previous cap, which means higher earners in expensive states. Capital gains get special treatment that most wage earners never think about. If you sell stock you've held for over a year, the profit gets taxed at preferential rates that are lower than ordinary income tax rates. This is why wealthy people who make their money from investments often pay lower effective tax rates than people who make similar amounts from working. Warren Buffett famously pointed out that his secretary paid a higher tax rate than he did because his income came primarily from capital gains, while hers came from wages. The system is designed this way intentionally to encourage investment, but it creates this weird situation where making money from money gets taxed more favorably than making money from labor. There's also the alternative minimum tax, which most people will never encounter but exists to catch high earners who use too many deductions and preferences. You calculate your taxes normally, then calculate them again under AMT rules, and pay whichever amount is higher. The AMT exemption for 2026 is $90,100 for singles and $140,200 for married couples filing jointly. If your income is below those thresholds, you're probably not dealing with AMT. Above those levels, especially if you have significant deductions or certain types of income, you might get hit with it. Self-employed people face a different reality entirely. You're paying both sides of FICA taxes, which means 15.3% right off the top on your net business income up to the Social Security wage limit. This comes as a shock to people who transition from employee to freelancer or business owner. They see their gross income and forget that they're now responsible for the employer portion of payroll taxes too. The government does let you deduct half of your self-employment tax when calculating your adjusted gross income, which helps a little, but you're still paying significantly more in payroll taxes than you did as an employee. What all this adds up to is a system that's far more complicated than most people realize when they're just looking at tax brackets. Your effective tax rate, the actual percentage of your income that goes to federal taxes, is almost always lower than your marginal rate because of how brackets work, because of the standard deduction, and because of all these various credits and deductions layered throughout the code. Someone making $75,000 might be in the 22% marginal bracket, but their effective federal tax rate is probably closer to 11% after accounting for the standard deduction and how the lower brackets work. Add in FICA taxes and it climbs to around 18% total. Still well below that 22% marginal rate they keep hearing about. The tax code incentivizes specific behaviors. Have kids? Get a credit. Work overtime? Get a deduction. Save for retirement in the right accounts? Reduce your taxable income. The government uses the tax system as a policy tool to encourage people to do things lawmakers think are beneficial. Sometimes it works. Sometimes it just creates complexity that benefits people who can afford tax advisors while confusing everyone else. Every April, millions of people either celebrate refunds or scramble to pay what they owe, most of them never really understanding how the calculations worked. They just know what they paid and whether it hurt. The system runs on a combination of withholding from paychecks, quarterly estimated payments for self-employed people, and annual reconciliation through tax returns. It works, barely, but it's not exactly transparent or intuitive for the average person just trying to figure out if they're paying too much. The bottom line is this. The tax system isn't designed to be simple, and it's not designed to make you feel good about what you're paying. It's designed to collect revenue while creating incentives for behaviors the government wants to encourage. Understanding how it actually works, how those brackets stack, what your real taxable income is after deductions, how FICA taxes operate separately from income taxes, that knowledge puts you in a position to make better financial decisions. You can't avoid taxes entirely unless you want to stop earning money, which defeats the purpose. But you can understand what's actually happening with your money, plan around the brackets, take advantage of credits and deductions you qualify for, and stop being surprised every time you look at your paycheck, wondering where it all went. The system takes a lot, more than most people realize when they're negotiating salaries or calculating budgets. But at least now you know exactly how much and why. That's more than most people can say, and it's the first step toward making the system work as much in your favor as it possibly can, given the constraints we're all operating under.